Hello, everyone. Good afternoon. Thanks for joining this webinar. My name is Abhinav. In January 2024, we at ValueQuest had put out a newsletter where we mentioned that this year would see heightened volatility for various reasons. Local politics, geopolitics, and so on, but also that we will take advantage of this volatility to generate superior returns over extended periods. The last 2 weeks have especially been a roller coaster. The markets climbed sharply after the exit polls, then they fell dramatically on the day of the results, and thereafter they have moved up again now to all-time highs, not really giving time for people to react. So to assist you in understanding how best one can navigate this volatility, what will not change after the election results, and what may change, we have our founder and co-founders on this call. As you know, Ravi is the CIO and fund manager of ValueQuest Platinum, and Samir is the fund manager for ValueQuest Growth. We will first begin with Samir for his thoughts, and then we will move on to Ravi. And the last 20 minutes, we will have Q&A as well. Samir, over to you.
Thanks, Abhinav, and thanks everyone who has joined the call. Yeah, this has been, kind of a major event. This is a year of a lot of major events. A lot of democracies in the world are going to have elections, plus Fed and geopolitics, etc. So there is going to be a lot of noise that we will have to navigate through. In the market, obviously, newspapers claiming all-time high, etc. will also be there. But this is the one major event where the outcomes have not been as anticipated, by the market earlier. And what does this modified era bring, for the next 5 years? Let's try to decode. I mean, like the market, BJP missed estimates. The pollster, if you see one day before, first exit polls or whatever, Pradeep Gupta was on TV saying that I'll give you results before the results, and the kind of confidence and stuff like that. Market also, kind of was maybe say complacent or whatever, but market had taken it for granted that this government will come and with a big majority, and that is where the big surprise or the shock had come. So if you see the right hand side of this chart, which is the vote share, total vote share for BJP went down from 37.3 to 36.6. It is the second highest vote share that they've ever received. The decline in vote share is very minimal, and that is gone to the opposition or the India Alliance. So their vote share went from 19.5 to 21.2. But if you dig a little deeper, the urban voters, the semi-rural and the rural voters have voted, kind of differently in this election. So BJP vote share in the rural areas has gone from, close to 40% to 35%. So that is a 5% drop, versus all India average of less than 1%. And on the urban areas, still, BJP continues to be the most popular. So we are all surrounded, by that demographic. But the rural voters have kind of moved to maybe regional parties or whatever. India Alliance vote share is 17.6 versus 17.1. And semi-rural is where, again, they have gained, and BJP has lost very marginally. So if you see the segmentation, then, vote share percentages, except for the rural area, has broadly been maintained, but it has had a dramatic impact on the seat share. So BJP lost, 60 seats. NDA lost 60 seats, BJP 50. And, this is in their strong areas. I think, a lot of seats have been lost in areas where they had 50% plus vote share. So that is definitely something, that they would have, kind of gone through, why this happened. It was, in a sense, that India shining moment where, we thought everything is hunky-dory, and then the election results have not been to the expectations, especially in the three states, the top three states. So UP, Maharashtra, Rajasthan, and Karnataka are the place. Karnataka, they fared actually a little bit better than what was anticipated. And the rural seat wins. So if you see 2019 and 2024, NDA from 225 is down to 190. UPA or India Alliance is up from 66 to 140. So that is the kind of big swing that the rural seats has created. How will BJP interpret these losses? Because, that first level analysis of this was that, now it's going to be a coalition government. There will be a lot of policy paralysis. There will be a lot of coalition compulsions. And there will be, kind of fiscal spending. That is, that was the first cut reaction of the market. But to understand what are the economic implications of this political thing and how will BJP interpret it and how they are going to go about it. So while we see that there have been losses in many states, they've had big gains as well. And in supposedly poor states, supposedly rural areas, MP, Bihar, Orissa, Gujarat. So though it's not like, it was one way sweep against, it is a mixed bag. And which means that, there would be a lot more than only economic policies that would have been the reason, maybe candidate selection or caste factor or somebody voting in this thing or some promises made by others. So there are a lot of factors that would have led to these losses, incumbency, anti-incumbency, etc. So this is the second highest vote share for BJP, and they are the largest party. So, again, 1-2 days after the election result, we heard a lot of things in terms of, how will this coalition be, whether or not, these guys will switch sides immediately, etc. What has to be understood is, BJP is still the single largest party and the majority party. So they have 240 seats and the next guy has 16 seats. So that is the kind of difference. So in terms of bargaining power, etc., nobody has, that kind of significant bargaining power that it can destabilize the government. We've had a lot of governments with much lower majority than 240. 240 is still a sizable number. And, the other parties are all, quite small. But needless to say, with 296 seats, and, when we say that, parties can switch sides from here to the other side for power, it can be the other way around as well. So, the view is that there will not be any kind of destabilization or whatever. This is going to be a stable government lasting full 5 years. So that is our base case in terms of, which government is going to rule India for the next 5 years. But, this rural loss, while there may be many factors, this is one key factor which has led to, there is genuine rural stress. Farm incomes have not been growing. So this is YOY growth, season-wise Kharif and Rabi. And if you see over the last few years, YOY growth in farm income has been going down. Not entirely in government's hands in terms of what they could have done. In hindsight, I think BJP would be thinking that, some amount of cash transfers, etc., would have helped in getting some more votes. But now that, that is water under the bridge, and this has to be acknowledged and something has to be done about, this farm income. Then these fiscal largesse that we keep talking about, right from the kind of seat demands that the coalition partners would have, or the funds demands, etc. Both these coalition partners have huge stakes in the states that where they operate. And they are going to look at the center to give some kind of assistance. Both the states wanted special status. And those are the kind of things that definitely, would play a role in the coming future. And, this last thing, and I'll come to that again, in terms of what kind of a cabinet we have. So, with all the speculation, TDP asking for 15 seats and, speaker post and deputy prime minister, we had all kinds of noises. What we have seen is, choice of continuity. Actually, there has been we would have expected more surprises, but that has not been the case. BJP has chosen continuity. So most of the large ministries have gone to the same ministers. Very few, only two ministries, that two Minister of Say has gone to coalition partners. So in that sense, they haven't had to yield as much. And you know what was there in the last slide and here, the key entry is the third last name in this, which is Shivraj Singh Chauhan. The MP has done phenomenally well for BJP in this election and in the state elections. And, you know, deservedly, Shivraj Singh Chauhan has come into the cabinet and has been given this very, very key ministry. So that is a minister and ministry to watch out for, but otherwise it is more of the same. What would be the cost of keeping these allies happy? So this is some, if special status is given, then you know there is obviously increased devolution from the center, and then there are some cash transfers also that would be there. The estimate would come to somewhere around 51,000 crores. So that is maybe the incremental spending that government might have to do to accommodate these two large coalition partners, and you know whatever special status demands that they will be there. Just looking at the BJP manifesto and what we have seen in the past two governments as well, that they have stuck to, or you know, they are committed to whatever they promise in the manifesto, and they are very, very consistent. So you know, whether it is stability, Garib Kalyan Yojana, Nal Se Jal, Awas Yojana, railway, renewable energy, defense, aerospace, electronics, and you know, making India energy independent, and electronics as a second major thing. These are the more of the economic promises that the government has made in the manifesto, and most of these would be, you know, they would continue to be committed to this. I don't think there would be any change in any of these. So these will be implemented and will be implemented with gusto. These are the initial steps that the government has taken. So there was this arrears to farmers under PM Kisan, and that 20,000 crores has been disbursed immediately. That was the first order that was signed by the cabinet. Construction of 3 million new homes under PM Awas Yojana. So see, this real estate cycle, which is in the third year today, is very, very strong. And you know, commitment of this, you know, the real estate has a multiplier effect on the economy, and government understands it, job creation as well as the income creation. So the commitment to real estate or PM Awas Yojana has been reiterated, and Shivraj Singh Chauhan. So fiscal consolidation has been the name of the game. I mean, that is what they have been pursuing, except for the COVID-led period where you know, some purse strings had to be loosened, and then there is a part to fiscal consolidation that has been committed. So FY24 will end with probably 5.5 instead of 5.6% that was budgeted, and the roadmap was to go to 5.1 and 4.5 over the next couple of years. That was the government target. Are we on track to this fiscal consolidation? We think so. The government has had huge positive surprises on the income side. These are the first time where, you know, in our lifetime, we would have seen where the government is exceeding their budgeted numbers in terms of direct tax, indirect tax, or you know, RBI dividend. So that definitely helps in terms of fiscal consolidation and gives them more room if you know, some spending needs to be done. So, and this is largely Capex driven. So you know, what we see as big swings in the government expenditure side are on the Capex side, which will have multiplier effect on the growth, and we are seeing that. Dividend transfer by RBI, so 1.25 lakh crore additional dividend that the government has received versus what was anticipated, is going to give them some room, you know, in terms of whatever larges, you know, whether it is to the states or to the rural areas. They have enough headroom to do that. What we believe is even with that increased spending, which will not be too much, the government borrowings will be in check. If you see last year also, the government actually borrowed less, or they kind of revised the borrowing number downwards. So they are not crowding out the borrowing market for private investment, which is one reason why India, so interest rates globally have moved significantly. In India, interest rates have moved up, but not as significantly. And so one of the reasons is inflation being in check. The second reason is that government also has kept their borrowings in check. So that we expect will continue. There is no change in that. There are positive surprises on income side. So borrowings will be controlled. And welfare spending, which has been, kind of constant except for the COVID period. If you see from 2014 to 19, as a percentage of GDP, it had actually come down. On an absolute basis, government has maintained the welfare spending, food security or MNREGA or whatever it is. So the absolute numbers will go up, but as a percentage of GDP, expectation was it to be constant, maybe 0.1, 0.2% bump up here will not throw the fiscal math out of whack. So we will see a little bit bump up in this welfare spending, but that will come from the positive surprises on the income side. Obviously, this rural stress, we need to pray to the rain gods. This year we are, there is expectation of normal monsoon, and that should help significantly, along with, whatever MSP, export ban, etc., whatever steps that need to be taken. That along with PM Kisan, where, they may bump up a little in terms of what cash transfers are happening, should help in actually reversing the trend a bit. So we all have to pray to the rain gods this year. So, the real estate cycle, government Capex in full swing, defense plans stay on track, railways plans stay on track. All lead indicators are pointing to uptick in private Capex, and Ravi will cover it later. But, we all elements are in place for private sector Capex to pick up, and we are seeing all the signs of that. Electricity, especially renewables, financialization as a trend is continuing. And in the consumption side, the premium consumption is doing well. Mass consumption or rural stress is, playing a part on the mass consumption side. What is improving? I mean, we have a base effect, and whatever steps we expect the government to take, rural growth as well as mass consumption should in the second half of the year show much improved trajectory, and chemicals export, volume growth is showing some kind of a revival. So the stories that were strong will continue to remain strong, and in fact, there are other segments of the market like consumption, which is expected to start doing well. Growth has been strong. FY24, we have ended with 8.2% real GDP growth, which is fantastic. Outlook also continues to remain strong, 7.2% growth. So basically, the outlook RBI has just revised it from 7% to 7.2%. This was the case last year also, where every RBI meet they have actually upped the growth estimates. So that continues. The expectation for growth is good. RBI estimates for inflation is also expected to remain in control. So overall, the Goldilocks scenario continues to remain. And yeah, so that, from the economic front or the macro front, we believe that India story continues, and there is not too much of a global domestic problem. Whatever it is may come from the globe. But yeah, I'll hand it over to Ravi to take it ahead in terms of how to navigate the market. Thank you.
Thanks, Samir. That was brilliant analysis of the election. Let me just share my PPT and let me know if you can see the screen.
Yeah.
Okay, great. So, a lot of people had a conspiracy theory that FIIs were aware about the election results, and they knew exactly that government might not come in with that kind of majority, and that is why they were short on the market. I laugh at such conspiracy theory and interpretation because even if they knew what the outcome of a particular event is going to be, there is no way to judge how the markets are going to react to that. Yeah, before the election results, people kept talking about 400, and people kept talking about getting simple majority. And if it doesn't happen, we were also, if this particular government did not come back, yes, we would have had serious fall in the market, because the uncertainty would have arisen about the continuity of policy. But this actually, the outcome fell somewhere in between, where the government came back and the continuity in terms of policy and political stability continues. So if anybody thinks that because there is a coalition government and we don't have stability, I think they're underestimating which is what people have done in the last 10 years, is that the Modi government has always managed to come out and surprise. So I don't think, like Samir's conclusion also, that this is going to change in any major way. Nothing is going to change. In fact, it is development, Viksit Bharat with double gusto. As far as my reading of the persona that PM Modi is, he is the one who's going to double down rather than back down in face of whatever tough situation the electorate has thrown at them. So let's quickly take a look at how the markets look. I have spoken with a lot of you one-on-one, and people were asking, if election results don't go in favor, then what happens? And I had said that knee-jerk reaction would be negative, but nothing will change the cycle of the economy and the business. This is just a chart which showcases what happened in 2004 when Vajpayee government lost out, and by a single seat, they kind of lost out. And in the first 3 days, there was a 20% kind of a fall. 1 month after the fall, we were up some 7%. 3 months after the fall, we were up some 15%. And 1 year post the fall, and these are three different indexes: small, mid, and Nifty. And small cap was up 117% only 1 year after Vajpayee government had fallen. And we know that, in fact, the next 4 years, markets had a fantastic bull run. Now, this is not to say that exactly same thing is going to pan out this year, but there is a lot to learn from history. So this time around, in fact, so why did the market not fall in 2004 post the government changing? The simple fact is that once a business cycle catches hold, once the economic cycle catches hold, a profit cycle catches hold, it does not reverse on a dime. A government at the center or at the state government also can accelerate, decelerate, or reprioritize the overall structure of what will do well in future. But it is very difficult for even the central government to change the direction. For example, if I were to say, I mean, first 10 years of Modi government, we have undergone so much cleanup in banking system. We have cleaned up humongous amount of NPAs. Now, that is not coming back. Corporate balance sheets are as clean as they have been. Now, that is not changing. So, and also, the businessman in general has a certain level of confidence because of the kind of profits that have been made in the last 3 years. That has also not changed. And with the current government coming back and policy continuity, it's gotten even more reinforced. So again, our economy continues to grow despite politics, and it is impossible for an economic cycle to change even if there is a huge change. And the government. Now, the good part is this time around, the government has also come back. So in all likelihood, in fact, it will be more of the same. And when I say more of the same, I am talking about, so there is a chatter about, consumer, agri, maybe export oriented stocks doing slightly better than capital goods, manufacturing, which has been the focus of the market in the last 1-2 years. Honestly speaking, that change might happen, but I don't think it is happening at this point of time. And the change will happen more because the valuation on the capital goods front and everything are going to reach a stratospheric level that there would be relatively the consumer oriented companies will become much, much more attractive. And it will not be because that something changes in the economy or the priority of the government. So, the Capex cycle, as we were talking about, see, the gross capital formation peaked in 2007 at about 36% and fell all the way to 27% during COVID. That has started rising. And the absolute number of GFCF is actually right where China was probably 20 years back, which is close to $1 trillion. If you had to say $3.5 trillion is the economy and we are at about 28, 29 or 1/3 of that. So yeah, about $1 trillion is the GFCF. This number can and will expand dramatically going forward, and we'll come to why. So it's been an investment-led rebound in the economy. Capex is firing on all cylinders. We are only in the year 3 of the Capex cycle, honestly speaking. And till now, majority of the burden has been taken up by central government in terms of the Capex cycle. So now within Capex cycle, what we believe is strongly going to change is that it will not be the central government that will be leading the Capex cycle. To put things in perspective, central government is only 20% of the total Capex. It is the state government and the household, which are the much bigger portion of it. And household is actually more than 50%. So it is the household Capex cycle that will drive the cycle going forward, and the private sector Capex cycle that will drive it forward. So to give you a perspective, in 2001, 2002 bottom, the Capex in the country was about 50,000 crores. And in a 5-7 year horizon, I think we peaked in 2010. At that point of time, the total Capex had reached a number of almost 7 lakh crores. Now that's almost a 13-14 times jump in the kind of Capex that was happening. Now in this particular cycle, we have bottomed at 4.5 lakh crores in terms of that's where the COVID bottom was. Now that 4.5 lakh crores has reached a number of 9 lakh crores in 23, and we'll probably cross 10 lakh crores in 24. But still, it is nothing. We have just doubled. It's not like a multiple of the starting point has been achieved or anything, and that is why capital goods Capex is not a cycle that one should be playing. We have no way to say how long and how strong this particular cycle will be, but the initial indications are it will be much, much stronger and it will be much bigger. Why do I say that? Because the last time around, the Capex cycle was driven only by the old economy sectors like steel, coal, road construction, and to some extent real estate and telecom. These were the 4-5 sectors that led it. This time, all these sectors are any which way reviving. But on top of that, we have some new age sectors that have come up. Renewables, data centers, all these did not exist at that point of time. Artificial intelligence is also going to drive a lot of demand for power, which is leading to a power cycle so we have to enhance our capacity in power, and we have to transition to a new renewable source as well. So from all perspective, it looks like there are added drivers in this particular cycle as compared to the previous cycle. Now, just going through some quick data point, India and corporates balance sheets are still deleveraged. Overall debt to GDP ratio is very, very comfortable. Banking system is very well capitalized. Our profit cycle has just begun in the last 3 years, as I said, and usually this cycle doesn't revive immediately. Our ROEs are now crossing 15-16%. And if you see in the previous cycle, they had peaked at around 26%. So we are nowhere near peak in terms of ROE, and we are nowhere near peak in terms of capacity utilization or leverage in the cycle. So everything points to a fact that there is a lot of headroom available for the current profit cycle to continue. Now, one thing is, of course, everybody is worried about the valuations. Now we are now today at about 4% of the world's market cap. So the world's market cap is roughly about 120 trillion, and we are at about close to $5 trillion. So that is roughly about 4% of the world's market cap. Now, this is a new high for Indian market. So clearly, there is some legitimacy in being worried about the valuations. But I will show some data points which will show that India should ideally be a much, much higher percentage of the world's market cap over in times to come. Why is that? Because Indian market has the depth, breadth, diversity, performance, and regulatory stability that is needed to attract capital flows. Now, till now, actually, we have hardly attracted foreign capital in the last few years. It's in fact, we will see that money has actually gone out. Now, first, let's talk about the depth. See, in global monetary in the GFC, global financial crisis, if you look at the right, in 10 months' time, we had a $11 billion of outflow, and that led to almost a 50% drop in Nifty. Now, subsequently, all the drops that we have seen have been far, far lower. But the one that I want to draw your attention to is the global monetary tightening in 21-22, where the US interest rates went from 0% to 5%. And in that, $25 billion flew out of India in a 9-month period. But yet, our market was barely down 3-5%. What does that tell you? That Indian markets have developed the depth. We all read the numbers about how much local retail money is coming in. Just from SIP, we are seeing a 21,000 crore a month number. On top of that, if you add insurance and insurance as well as EPFO money, that will be another $1.5 billion. So domestic flows itself are roughly about $4 to $5 billion, which adds up to about $50 billion a year. So, and foreign holding is already down to a number where they cannot be selling too much more, in my opinion. So that's on the depth of the market. Then on the breadth of the returns. So India has had the most number of multi-baggers across markets since 2000. So it is not that only in the last few years money has been made. Money has been made since 2000. Okay, and we have had almost we are responsible for almost 54% of the multi-bagger over across all markets. Now, and these multi-baggers are usually returns of greater than 10x over a 5-year rolling period. And total stock returns for multi-baggers is within a 5-year rolling period is also on a high. As in India, only Australia is the only one that is ahead of us. Otherwise, we are ahead of the median returns of 16x. So we are closer to 23-24x. That is the kind of return that multi-baggers have given in India. Now this is the time distribution of when these multi-baggers have been created. So if you look at the India, since 2003, we have consistently being seen, except for 2009, which was a bad year. Every year we have had at least a few multi-bagger returns. And if you see 2023 actually produced only 3. So we are coming from a base where the multi-bagger returns have been low in the last year. And now suddenly markets have started performing again. So I won't be surprised if the 24 number turns out to be a big one. So breadth of the returns are on a high. Then coming to the diversity of Indian market as compared to let's say Brazil or Russia. Anyway, Russia is not a market that is accessible anymore, but our markets are much diverse. We have representation from sectors like auto EM, ancillaries, financials, building materials, chemicals, consumer, industrials, IT, platform, service, pharma, power, commodity, so metal, mining, oil and gas. There are so many sectors, and we have had winners from every sector. So it is not that in terms of time period we have had multi-bagger, in terms of diversity we have had multi-baggers, and in terms of long period of consistency also we have had multi-baggers coming through. Now, this is the India has always been one of the top 3 markets in 1, 3, 5, 10, 20, 30-year period. So US is the only other market besides India that has consistently generated these kind of returns. And in fact, India has done better than US also, but in local currency terms. Probably in dollar terms, we have not done as well as US. And India deservedly trades at a premium to the emerging markets because of these reasons: performance, consistency, depth, breadth. India's premium is justified at this point of time, given higher growth, return on equity, and consistency. See, I had tweeted a couple of days back that, if India's GDP currently is 3.5 trillion and our corporate PAT to GDP is roughly at about 5%, I feel this time our GDP will go to 5 trillion sometime in 27 or 28, and our corporate PAT to GDP will actually accelerate to crossing more than 8%. Actually, when I say 8%, it will be combined listed and unlisted. So, but a lot more of the unlisted market will start getting represented in the market. So there will be a shift away from shift towards the market cap going towards the listed place. Now, why do I feel confident about the corporate PAT to GDP crossing? Number one, our tax rates are lower this time around. We are 25% as compared to previous cycle when we were at 37-38% kind of corporate tax. Number two, some of the greenfield capex is actually coming in at 15% because of the PLI, and there are many PLI incentives and scale related benefit that are being offered. Number three, our capacity utilization industry wide is still at 75%. And number four, I think we have not yet fired on all engines in terms of growth. So rural consumption, exports, some of the pockets of the economy are still not doing that great. So that provides us the headroom for us to grow much beyond 8% probably. So yeah, so this is the chart that talks about that. So we reached a peak of 7.9% in 2008, which was listed plus unlisted, and we are at 5.2% today. And we will cross this, the listed market will easily cross the 6.2 peak that it achieved in 2008, and will probably go near 7-8%. The big trend that we have all been witnessing is that, the kind of financialization that has happened of saving. So one is, of course, our economy has started saving less as it used to compare. So 35% of savings has dropped to 25%, and that number has started going up. That is number one. But number two, within that, the breakup of the shift is happening away from physical assets towards financial assets. And a bigger proportion of that is starting to flow towards equities. So even today, only about, as I mentioned, $40-50 billion is flowing towards equity. That number, can it become $100 billion in the next 5 years? I will not be surprised if that kind of money starts flowing into equity markets on an annual basis in a 5-year horizon. Very simply because we save about $700 billion a year. And out of that, we are putting $50 billion into equities. So FIIs, actually, this particular rise that we have seen in the last 3-4 years is marked by a very conspicuous absence of FIIs. And their worry has been valuations, and I don't blame them, but valuations have kept them away from one of the best performing market outside of US. And I don't think if prior to election there was a justification that there could be a regime change, one should stay away. Now I feel there is no justification for FIIs to not have presence in the Indian market. See, even when market is quoting at a 20p multiple, or rather the Nifty index, you will always find companies where the improvement is about to change, or the performance is about to start improving, and valuations are quite reasonable. So we are still able to find opportunities in the market. Just to name a few sectors so that you understand, I think financials, especially the large private banks, are quoting at a 10-year low multiples. Now, there are some questions and worries about the growth rate sustaining and the NIMs expanding, or the ROEs going back to the 20% plus. Honestly, I would be really, really surprised if our bet is that the private sector Capex will pick up. The lending business will do very well going forward. And FIIs will come in over there. So FIIs have been sellers most in the financial sector, and that is where the most opportunity lies in our opinion. But besides that also, there are other sectors like non-lending financials, whether it is insurance, general or life. Those sectors have not performed very well over the last 3, 4, 5 years as well. And there is a possibility that can revive. There are pockets like consumption, which have not done anything for 3 years, 4 years. That can start doing very well. Export oriented. IT is not something that I'm bullish on even at this point of time. But the point I'm trying to make is, it's not like everything in the market has gone through the roof and there is absolutely zero pocket of valuations comfort in the market. Market generalizations tend to distort the reality more than one can expect. So yes, you have to be careful not to enter spaces where there has been a lot of run up, or there has been a lot of speculation, but that does not mean that there are no pockets of valuations, attractive valuations in the market. The chart on the left suggests what kind of money has come in, and if you can see, there is hardly any money has come in. And the chart on the right suggests the fall of the percentage ownership of the FIIs. Today, now FIIs, in fact, this is 2-3 months dated. In my opinion, this number is at a 10-year low. We are at a lower level as compared to the global financial crisis, where I think FIIs used to own about 17% of the market. That is the number that we are close to. This is a technical data point, but this is just after the election result. We are at one of the highest short position in terms of from FIIs. And what has happened? Market did not give any chance for FIIs to react. If you see last few days, constantly they've been trying to cover their shorts. And in fact, they are still net short. In my opinion, this market is not going to peak until we see a huge buildup of long positions from the FIIs. Why will they build long? Usually the way this works is that they first build a position in the derivative market and then they follow it up with the cash position. So they have been covering their shorts, and now they will start building longs because they know they themselves are going to be the buyers in the cash market. So they first buy in the index futures or futures market. So this tells you that next 1 year return, when I say 1 year, it's not 12 months. The returns can come in 6 months also. But there is a possibility that the markets will surprise even from here at a more positively than we have seen till now. If an event like election and such an outcome could not shake the faith of the market, a correction which did not last even a day, that is the kind of inherent strength that we can see in the market. I see very few things that can shake that kind of bullishness out of Indian market. So to conclude, what are the conclusions? Does anything change in either portfolio strategy or economy after election? We are saying nothing major. No. Portfolio strategy incrementally, maybe we'll start looking at consumer, agri kind of and pharma kind of opportunity, but that is incremental, not necessarily a given. Perhaps there will be some fiscal policy loosening versus the expectation, but that will also be pro-growth, and that does not mean the focus moves away from Capex. In fact, as I said earlier, the Capex cycle is anyway moving away from central government towards private sector. So it will not be a needle mover, even if central government was to start focusing a little bit on the welfare. And the overall cycle is in very solid grip, and it will continue. So we spoke about it, agri consumption and rural will start getting some focus. And there will be more broad basing of companies and sectors that do well. Yeah, so with that, I will end my presentation and I will take some questions. I mean, Samir and I will take some questions on. So, Abhinav, if you can, moderate the questions.
Yeah, sure. So we have a few questions. I think in the interest of time, I'll combine a few which are similar in nature. So someone had asked, what is GFCF? So GFCF would be gross fixed capital formation, right? Yeah.
Gross fixed capital formation.
So in layman's term, if I were to explain GFCF, when a company does sale, how much of that converts into cash? It's the cash flow generation of a company is called operating cash flow. A cash flow generation in an economy is called GFCF. And that is actually what gives everybody in the economy confidence to put more money into their business plans.
Okay, thank you. Then there are some questions on valuation. I know both of you addressed that, but let me still ask. So there's one investor who wants to know, are we in bubble territory? Are the panwalas also suggesting stocks? There's another investor who wants to know, even ValueQuest portfolios have stocks which are in the high PE, which is 60, 70. Are you comfortable? Is it justified? Can this PE move further up as well?
Yeah, so no, it's a good question, legitimate question, and everybody has worries around it. And I am not trying to justify the valuation, but let me give you a sense. As I mentioned during my presentation, one example I gave is, see, when a cycle turns, it is very difficult to predict where this cycle will peak. And anybody who's looking at the current valuation and saying that, this is where we should peak, or this much is the valuation that we should be going there. I feel there is no, if we have to not perform for 3 months, or if we give flat returns for 3 months or 6 months, I think we will again be back to a very, very reasonable number. So 10%, 15% drawdown or a 3-month, 6-month correction cannot be ruled out. But at the same time, that is not a good enough reason for us to get out of a car which is actually catching speed. See, if I were to give an analogy of car, we have now just moved from 3rd gear to 4th gear, and we are starting to drive at the speed of 60, 70. Now, if today's roads are any example, we can easily go till 120, 40 without, of course, there will be accident after that, and that can have consequences. But what I'm saying is 60, 70 is now a normal speed. In fact, if you are traveling on one of these Atal Setu and Expressway, 60, 70 will feel like slow, like you're not moving. So the speed in the economy is just about catching up, and one should not try and preempt where this particular cycle ends. We will end up being wrong. 50,000 crore Capex number going to 7 lakh crore in a 5-year horizon is unimaginable. Nobody is talking about today. 4.5 lakh crore is the starting point of this Capex, that we will end up with 30,000 lakh crores. That's a huge number. I'm having trouble saying the number also. 4.5 lakh crore going to 30 lakh crore. Can it happen? I don't think it is outside the realm of possibility. Can it happen in next 5 years? I don't know. We will wait and see. But because the positivity in the cycle is just getting built, it would be not good on our part to anticipate and say that, okay, this is where it should end and we should get out of it. You might predict the starting point, but nobody can really predict how the end point of it. We will take it as it goes, because right now there is no leverage in the economy. There can only be correction in the market. It will not be an economic downturn in the economy. Samir, you can add to it. Sorry, it was a long-winded answer.
No, economic data. I mean, it's a valuation question, and valuation is the art part. Who says, where it will peak and how much can it go or whatever. We have to trust the collective market wisdom in terms of it. There are some pockets of extreme high valuation, and are we are avoiding that in terms of where we are buying a fresh or whatever. But in general, yeah, like Ravi mentioned, banking, or there are several other places where valuations are actually attractive. So you can't paint everything with the same brush. Pockets of market which are expensive will be avoided in terms of us buying, or we have some sense of the strong earning growth. This will not be 10-15% earning growth. If we are buying at say 40 PE, then it is something where earnings growth will be similar. So we have to look at price to growth. You have to look at cash flows, the kind of scale change that the companies are doing. There are actually a lot of factors, but needless to say that the entire market is not expensive. You are finding pockets of opportunity.
Yeah, I'll just add. So what point you made about price earnings to growth and cyclically adjusted PE are a better measure than just looking at the PE multiple. Basically, yeah, that will capture the growth expected as well as the stage of the cycle that we are in. And that will probably give a better perspective on the valuations.
Okay, thank you. Now, there's an interesting take on FII flows, Ravi, from where you had left off. So this investor is saying, is it not better that FIIs are cautious because they're known to cause havoc when they exit at short notice? So it's probably good that they are cautious in staying away from India.
No, so I don't know better or worse. We have to not be prescriptive about it. We have to understand what's happening, why it's happening, and will it change. My sense is there are two reasons why FIIs have been selling or not been coming in the market despite the strong fundamentals. One is valuation, but the other aspect of it is that generally it is the US market which is attracting all the money, and it is doing so at the expense of the emerging markets. Now, India is also part of that emerging market basket, which tends to get money flow when the emerging market manager gets money. So automatically, whenever a dollar is taken out of emerging market basket, 15 cents go out of India also. So that, in my opinion, is the reason. And second thing is, see, it's like it is very easy for anybody to say, India is expensive, I won't buy. And if you buy and then if market goes down, then you lose your job. So all fund managers are also finally driven by their own incentivization. But it is hard for anybody to explain buying at India at this point of time, so they don't do it. But what happens if market performs from here as well? It will become harder and harder for people to explain why they did not invest in India.
Okay, sure. Now, there are two separate investors with questions on PSU and IT sector. Maybe Samir, you can take one, and Ravi, you can take the other. So ValueQuest has generally avoided PSUs and generally avoided IT sector as well. Would we continue to avoid them, and why?
Actually,
yeah, Samir, go ahead.
We can see what kind of businesses we like is very important. We like businesses of very high quality. There has to be superior growth versus what the segment offers. There has to be profitability or base amount of profitability and cash generation. So that all defines the quality of the business. So we like quality, we like growth, and then we like valuations as well. So generally, reversal to mean kind of stories or whatever. See, PSUs is just one thing. It is pure momentum. Never say never for us. We only like to have, our criteria in terms of what kind of quality of businesses we want to buy, what kind of growth do we like, and then we have to have some kind of a differentiated view versus the market. We did make an exception. We had PSUs in our portfolio, so there is no compulsion. In fact, what we say, we are absolutely sector agnostic and market cap agnostic, and we always look at it. But it is, buying equity shares is being partners in the business. So How we classify is otherwise it's a trade. If you want to participate in the momentum, you can do it in your own portfolios or whatever. It's just participating in the momentum or tactical or trade. But if you have to invest, then you are becoming partners in a business. You better have some differentiated view or differentiated business that you partner with. So it is more of what we have on the table, from which what we get excited about and what we have bought. Now in the market, our stocks also, some segments have done fantastically well as this thing. And yes, I mean, there's no denying that PSUs have done well, and we will keep evaluating at all points of time. So same goes for IT, high quality businesses for sure. But given global sluggishness, etc., and the AI and the kind of disruption that is there, we need to see they are at peak utilization. They are actually the lead indicator, which is headcount addition, is absolutely close to zero. So we are not in any kind of a hurry. We are able to find maybe better businesses. You have to choose which parties you want to go to. So our approach is always sector agnostic. Yes, we like more secular businesses. We like high quality businesses. We like to take 3 to 5 year views, and we like businesses that are going to change scale versus reversal to mean. So whatever businesses qualify for that criteria, I think, and yeah, you will always miss some, and the regret list is always far higher. There is always going to be the case. But Ravi, if you want to add.
See, we don't look at it from the prism of small cap, mid cap, large cap. We don't look at it from the prism of privately owned, government owned. We look at it from the prism of which business will do well from the next 3-5 years perspective. And if these businesses do well, which are the companies that are best positioned to take advantage of that business cycle. So for us, PSU banks is only a reversion to mean trade. But having said that, would we be okay to take a bet in defense? We would do that even if it is PSU. I'm not going to take a bet because defense has already done very well, way better than anybody had anticipated. But it's a defense, that business that we are bullish on, rather than because it is a PSU or not PSU. At this point, if we are bullish on defense, then there are hardly any private sector plays anyway available. They are all PSU defense only. So again, just summarizing it, we will look at businesses that can do very well and companies that are positioned to take advantage of that.
Okay, great. Now, in the interest of time, we'll just go with 2 more questions. If any of the other investors' questions are unanswered, you may please contact your RM, and that RM will help you. So, Samir, one question for you, and Ravi, one last question for you. Samir, the question for you is thoughts on the upcoming IPO cycle. Ravi, the question for you is impact of India's inclusion in the various global bond indices. So, impact on currency and interest rates.
So, Abhinav, we've just put out this note on India wealth creation, where all these, whether it is IPOs or startups or whatever, where equity wealth is being generated and what kind of a mega trend. I think, everybody who is in the business, has that feeling we are at the right place, right time. And, if you see the trend in terms of the IPOs that are come or that are coming, one, in terms of quality of IPOs, we still feel there are, very good quality of IPOs. Like recently we invested in one hospitality-based IPO. So very, very exciting businesses that are coming to the market. Ravi also alluded to it. A lot of private companies are going to come to the listed market space. So I am, kind of pretty enthused by the kind of quality of the companies that are coming. And believe me, most of the IPOs, are not able to price it exorbitant even now. So the market is very rational in terms of pricing these IPOs, or if the promoter comes with an expectation of, a high price or whatever, I have seen 30-40% reduction, no matter. So lately, Go Digit was the last one. You see the kind of last round valuations and the kind of valuation that they thought they wanted to come with and what valuations they have come with. So in terms of quality of the businesses also is pretty good, and in terms of valuations also still there is sanity. So in that sense, this should remain. I mean, this as the market keeps going up, as valuations go up, obviously, there will be that tendency, private equity owned or whatever, to cash out. So we will see healthy IPO pipeline.
Abhinav, could you repeat my question?
Yeah, India's inclusion in the global bond indices, so impact on currency and interest rates for that.
So I think India will attract more and more flows, both on the bond market as well as on the equity market side. I would say we will attract anywhere between 20 and $30 billion on the bond market side, and will attract anywhere between 30 and $40 billion on the equity side as well. Ideally, that should lead to at least rupee not depreciating any further from here. Will we appreciate? That actually depends on how RBI views the Chinese currency. It is not so much the dollar that RBI is worried about. It is the Chinese currency, because most of the places we tend to compete with the Chinese companies, and RBI, it is also part of RBI's unsaid mandate to ensure that Indian firms don't lose competitiveness versus China. So if Chinese yuan tends to be weaker, rupee will also follow that. If Chinese let the rupee, their currency appreciate, then you will see rupee also appreciate. But having said that, I think there is one fundamental change that we are seeing. See, the fundamental reason why India is the currency is weak is because our current account deficit and fiscal account deficit have always been on the higher side. Current account deficit, we are starting to get it under control, where our imports are growing slightly slower than they used to grow, and our exports are growing slightly faster than they used to grow, and hopefully we'll cross that bridge at some point of time in future. On the fiscal deficit front also, we have been the least to blow up during COVID times, and we are bringing it under control much faster than the developed world is. So both the things are pointing to the fact. And then our biggest imports are electronics and crude, besides gold. Gold we cannot do anything about, but electronics, we have done something about it. Now we have become net exporters. And on the crude side, we are trying to move away from crude towards renewable energy. And once we have enough of renewable energy built, our crude imports will also start going down, or at least as a percentage of the energy required, it will go down. So percentage of GDP also will go down, and that will bring inherently a lot of strength into rupee. So I think one cannot say next 3 months, 6 months, but over a 10-year horizon, I don't expect rupee to be as weak it has been in the last 20 years.
Okay. So thank you, Sami. Sorry, Ravi, you're saying something?
Yeah. So I just want to address a few technical questions which are there. I think there was one question about, I mean, generally what the AUM is. I think we are at 14,000 crore. And is that an issue in terms of managing? I think we are just getting started. We haven't even scratched the surface. In terms of the universe that we address, it's a okay, India is a $5 trillion economy, and we are a $1.6 billion fund. If we are to become a problem of managing 1.6 billion in a $5 trillion, sorry, not economy, but the market, then I think I don't know how the larger guys manage. So nowhere close to the size being a problem at all. That's number one. Number two, some people asked about some near-term underperformance or missing out on PSU defense and all. As I think we have made it clear that we will stick with where our confidence is, and 3 months, 6 months is too short a time period to be judging performance, honestly. In fact, if you see in the post-election, some of the stocks that have not been doing well in our portfolio suddenly have given a 20-30% kind of a rally. So stay focused on the fundamentals and give it long enough time. Eventually, the fundamentals will prevail. Yeah, with that, I'll just hand it over back to you, Abhinav.
Yeah, perfect. No, thank you, Samir, and thank you, Ravi, for all the thoughts and insights. And thank you to all the attendees. We had a good audience. And I would like to thank the audience for being there for this call and for being partners and supporters of ValueQuest.
Thank you.
Thank you. Thanks, Abhinav.
Thank you.